Ever pondered on how volatility trading strategies work? How do traders and investors profit from the ups and downs, the ebb and flow of the financial markets? Today we delve into the world of volatility trading strategies, unraveling the techniques that traders use to make profits from the fluctuations in the price volatility of financial instruments. First up is volatility spread trading. This involves taking positions in options or futures contracts with different levels of implied volatility. The game plan here is simple. Buy options with low implied volatility and sell those with higher implied volatility. The aim? To profit from the convergence or divergence of volatility levels. Next is the straddle and strangle strategy. A straddle involves buying a call option and a put option with the same strike price and expiration date simultaneously. A strangle, on the other hand, involves buying out of the money call and put options with different strike prices, but the same expiration date. The idea is to profit from significant price movements regardless of the direction. The volatility index, or VIX, often called the fear index, measures the expected volatility of the S&P 500 index options over the next 30 days. Traders can speculate on changes in market volatility using VIX futures or options, buying when volatility is expected to rise and selling when it's predicted to decline. Gamma scalping is another strategy that involves adjusting options positions to maintain a neutral delta while profiting from changes in the underlying asset's volatility. Traders continuously rebalance their options positions to capture gains from fluctuations in the options gamma. Exchange-traded funds, ETFs, and exchange-traded notes, ETNs, linked to volatility indexes or futures contracts, provide retail investors with access to volatility trading strategies without directly trading options or futures. Statistical arbitrage involves identifying mispricings between related assets or securities based on historical volatility patterns. Traders use statistical models and algorithms to exploit temporary pricing discrepancies, profiting from mean reversion in volatility. Lastly, volatility risk premium strategies involve selling options to capture the premium associated with heightened volatility expectations. Here, traders sell options when implied volatility is higher than historical volatility, betting that the market's volatility will revert to its long-term average. Remember, while these strategies provide opportunities for profit, they also come with risks. Volatility trading strategies can be complex and involve significant leverage. Market conditions and volatility levels can change rapidly, requiring active monitoring and adjustments to trading positions. So, always conduct thorough research, utilize risk management techniques, and consider seeking advice from financial professionals before diving in. In summary, volatility trading strategies are a toolkit for profiting from the inherent uncertainty and variability in the market. From volatility spread trading to statistical arbitrage, these strategies offer a range of methods to navigate and profit from market volatility. But remember, with great opportunity comes great responsibility. Manage risk carefully, stay informed, and happy trading.